Hello and welcome everybody. I'm Tom Bowley, Chief Market Strategist at earningsbeats.com, and this is Trading Places Live. It's Wednesday, September 29th, 2021, and I'm pre-recording this Trading Places Live for Thursday, September 30th. Currently, futures are pointing to a solid open on Thursday. Of course, it is still early. We've got the night to see, how things unwind throughout the evening. But at least for now, it looks like we are going to get off to a decent start in the morning. We'll just see if that carries over. The Dow Jones futures are up about 108 points. S&P 500 futures 16.25, and NASDAQ futures up about 60. So on a relative basis, it looks like the NASDAQ doing a little bit better. And that goes against what we've been seeing the last couple of days as the NASDAQ has been getting hit harder with yields on the rise. Let's go ahead and take a look at the agenda for today. So we're going to start off with the daily market recap, as we always do. Take a look at what happened on Wednesday. Then we'll get into talking technically. I want to go through some of the sectors, also point out a big breakout. I don't know if you saw today, but we'll talk a little bit about that. Then get into October seasonality. So getting toward the end of September. So I'll give you a little heads up on a few things I'd be looking for based on history anyway, as we move into the month of October. Then into earnings spotlight, and we'll wrap up the show with the 3 you must see. But before we get into any of that, let me take you over to earningsbeats.com, where if you scroll down, you can see on the left-hand side, there'll be an area where you can subscribe to our free Earnings Beats Digest newsletter. This is a newsletter that's published 3 times a week, Mondays, Wednesdays, and Fridays, normally out by about 8:30 a.m. Eastern, which is roughly about an hour before the market opens. All you have to do is type in your name, email address, hit that subscribe button. We'll make sure we get you set up. Also, we've got a big event coming up in a couple of weeks, and everyone in our Earnings Beats community, both members and also free Earnings Beats Digest subscribers, all will be invited to this free event coming up in a couple of weeks. So you do want to make sure you're part of the community. I don't want you to miss that. So definitely hit that subscribe button after entering your name and email address. There's no credit card required. You can unsubscribe at any time. We would love to have you. I think it's very educational, and certainly can use some of the information. I think it's actionable, so you can use some of that information to trade if you'd like. All right, let's talk a little bit about the action from Wednesday. It was not a good day for the market. Now, in terms of losses, it wasn't that big a deal, especially with what we've seen a couple of times over the last 2 weeks. Seen some pretty big down days, but I didn't like the action. And to me, it seems to be pointing towards some more downside coming up. I hope I'm wrong. I do still like the long term a lot as we go forward. So I think this is a short-term period of weakness, possible little sell-off here. Maybe an ABC correction is one of the things I've been looking at. But anyhow, the action on Wednesday, Dow Jones Industrial Average up 91, S&P 500 up 7, NASDAQ down 34. There's that relative underperformance on the NASDAQ. Mid caps were flat and small caps finished up almost 5 points. So on the surface, it didn't look like a bad day, but considering what's taking place under the surface, which I'll get into here in just a minute, that didn't bode, or I don't think it bodes well for the short term. And again, I hope I'm wrong. Utilities, the best performer, up 1.3%. Staples, consumer staples, up about 0.9%. Healthcare up 0.8%. And then we had real estate up just about 2/3%. So the good news is those 4 groups did really well. The bad news is those 4 groups are defensive groups. So we get our first opportunity to rebound in the market, and defense leads. So it's just telling us the market's a little bit nervous, a little cautious, money rotating into defense on this initial rebound attempt. And that to me is bearish in the near term. So I think we have to be a little careful. The worst performer on Wednesday was materials, XLB, which dropped about 0.4%. All right, 10-year Treasury yield. As far as economic news goes on Thursday morning, this is what you can expect. Q2 GDP, third estimate, will be out in the morning. The estimate is 6.7% GDP. The second estimate, which came out last month, was 6.6. So we are looking for just a slight increase with this third estimate up to 6.7%. Then we've got initial jobless claims. Of course, we always get those on Thursday mornings. Last week, 351,000 claims. This week, we're expecting 335,000. So we are expecting that number to go down a bit. Then September Chicago PMI. August came in at 66.8. We're expecting September to come in at 65.3. So a little bit of a drop there from the August level. As far as the 10-year Treasury yield goes, I mean, we got that breakout above 140, and we have seen a lot of selling in bonds since. So we saw the selling trigger the yield moving to the upside, got the breakout, and that triggered more selling of bonds, which has resulted in even further movement to the upside in the 10-year Treasury yield. Good news is we are seeing financials and industrials moving higher. The bad news is that the higher yields are really putting pressure on technology stocks. And technology is almost 25% of the S&P 500. So if you're looking for the S&P 500 to take off, we're going to need to see technology reverse back to the upside. And at this point in time, that doesn't appear to be likely. I mean, we may see a little rebound, but I don't believe we've seen the lows yet based on the way the market traded today. So let's talk a little bit about how that market traded today. Here's the sector summary. And there are your four groups that I just talked about: utilities, consumer staples, healthcare, and real estate. Four leaders, and really the only groups that made any headway whatsoever to the upside, or at least of any substance. Next up was industrials, 0.11%. So, you know, if you weren't in defensive areas, you probably didn't see a whole lot of movement to the upside. Now, obviously, there are going to be some industry groups, there are going to be some individual stocks and so forth that kind of went against the grain. But big picture, there wasn't a whole lot going on in any area outside of defensive areas. And as I said earlier, materials down 0.4%. That was your laggard. Now, the interesting part, and one of the things that I find very interesting, and I'm going to come back to this chart, 5-year chart in just a minute, but I'm just going to bring up a 1-year chart, because look at the dollar breaking out above this 94 area, going out to the last year. You can see that we're right up now to 52-week high on the US dollar. So I've been calling for a rise in the dollar. We're getting it. I know we've had pretty good movement to the upside in energy recently, but not in materials. And when the dollar's on the move to the upside, those two areas, energy and materials, tend to underperform on a relative basis to the S&P 500. Not necessarily on an absolute basis, but on a relative basis, we tend to see underperformance in those two areas when the dollar is rising and breaking out. So just keep that in mind. I'm not saying that's what's going to happen, but history tells us we want to be careful. Now I want to go back and show you that 5-year chart, because when I look at this, I'm going to annotate this for you. And I'm going to show you the area of support. I mean, if we go back to the latter part of 2018, which would have been the when we were having the trade war, fourth quarter. So I'm going to go down to about 94.5, up to about 96. And that right there was your key support. So if you look back in October of 2018, we bottomed here, January 2019, and then again at the beginning of February 2019, bottomed in this range. Two more bottoms, March and April. Actually, looks like maybe beginning of March and then later in March. Then again in June of 2019, came to the top of this range beginning of 2020, and then with the pandemic in March, went to a low of about 94.5. My point is, for about 18 to 20 months right in here, you can see 94.5 to 96 held as support throughout that entire period. Once we went through, that area now becomes resistance. So what I'm going to do is I'm going to draw what I would look for as we go forward here. So that right there should provide a resistance zone as we move up. So here's the dollar coming up to 94.5. You can see when we tried to rally back in September of 2020, we struggled once we got into that 94.5, 95 area. We got almost to 94.5 in November of 2020. And now here we are again, moving back into this area. So I just think we have to be a little careful with the dollar as we get into this zone. I think eventually we're breaking through 96. I think the dollar is going to strengthen. Just my opinion. But in the meantime, before we actually get above 96, we may run into some difficulties trying to get through. And it may take a while for the dollar to break through. This may not be something that happens in 2021. If I'm right and we do get the breakout, it could be sometime in 2022 before we actually move through 96. We'll have to wait and see, kind of play it by ear. It would be very bullish if we just went right up through 96. It'd be bullish for the dollar, that is. All right, so let's come out of here for a second. And I want to show you the long-term chart of the dollar. Because the dollar, you can see back at the beginning of the century, first decade, the dollar was very weak. And as a result, energy and materials led during the 2003 to 2006 bull market, 2007 bull market that we had back then. So when the dollar is weak, some folks just look short term and they think, okay, well, the bull market has to have a falling dollar. And now some might look at this and say, well, the bull market now has to have a rising dollar. Bull markets can have either one. But you have to recognize that when the dollar is rising, energy and materials tend to lag on a relative basis. When the dollar's weak, like it was in the first 8 years of the decade or even 11 years of the decade, that's when you're going to see outperformance by energy and materials. Energy and materials led the bull market 2003 to 2007, the stock bull market. And those two groups have been lagging during the current bull market because it's more about the dollar than it is about the stock market. All right, so I just wanted to point that out, make sure everybody is aware. I'm going to move on now to an area I think is really interesting. This is going to be October seasonality. So I do a lot of analysis. I keep a lot of information regarding seasonality on an Excel spreadsheet. And then I do a lot of sorting by month in order to come up with this information. And I have a seasonality report that I send out to members at the beginning of every month. So one will be coming out here over the next couple of days as we wrap up September, move into October. It's for paying members at Earnings Beats, but I just want to give you a little taste at some of the things that we look at. So the first thing first stock I want to show you is F5. So notice first on the drop down, normally the default is that symbol summary or sharp chart, but I've pulled up seasonality. And so when I come over here now and click on the go, it'll bring up by default 5 years of seasonality on FFIV. So it breaks it down. How often has FFIV gone up each calendar month? That's what these numbers at the top of each of these bars represent. So 40% of January's, 60% of February's, it's gone higher, and so forth across the spectrum. But what I want to do is I want to take this and I want to drag it back. Now we could drag it back. I'm going to drag it back full 20-year period. So this includes both bear markets and bull markets. But over the last 20 years, you can see that FFIV has averaged gaining 9.9% in the month of October. October alone, that's been an average. And it goes up 3 out of every 4 years, roughly 75%. So FFIV seasonally likes the month of October. And even better news is things don't really let up in the month of November. So this is by far, or these are by far the two best months, calendar months for FFIV coming up, October and November. Now, that information is nice, but I would then take that and I would look at the chart and just see, do I want to trade the stock? Does it look good technically? Well, 215 is a major area of resistance. I think we're kind of in this uptrend, followed by a cup, followed by a handle. So I think as long as gap support holds at about 192, 193, I think we're fine here. And if we do get the eventual breakout over 215, the measurement would be 215 down to 175, the bottom of the cup. So that would give us $40 on a breakout to 255. So the way I would be looking at something like FFIV is my measurement would be 255 on the breakout. So that's kind of my target. That's what I'm thinking is going to happen looking at the chart. And then to the downside, what I want to do is I just want to make sure that I keep my stop in play. And for me, that would probably be this gap support area around 192, 193. So I could look at a stock like this and be looking maybe 255 to the upside, which is $53 from here, and only maybe $7 or $8 to the downside. That's a pretty nice reward to risk. And that's the way I would be using seasonality. I wouldn't pick this stock just because of seasonality, but I want to be aware of the seasonal tendency and then look at the chart and see if I like the chart. So the technical picture, the technical outlook is what you want to primarily use to decide whether to buy or sell a stock, in my opinion. But the seasonality can be used as a secondary indicator to either confirm what we're seeing on the chart or refute what we're seeing on the chart. Could go either way. All right, so that's the first one. Let me give you some others. So next up, how about Google? So Google, if you go back 20 years, or 18 years, you can see October, 9.9% is the average return. And in October, it goes up roughly 3 out of every 4 years in the month of October. So 76% of Octobers are higher, and to an average of 9.9% per October. And if you look across here, July is 5.4%, April 5.1%. And then another month, it's only 1.1% in January, but look at 76% of the time it moves higher. One thing that January, April, July, and October, the 4 I just pointed out, one thing that they all have in common, they're all the first month of the calendar quarter. They're all leading up to Google's earnings report. And I talk a lot about pre-earnings runs. So just keep that in mind, that we're heading into a month where obviously we've got the potential pre-earnings run, but also heading into a month where we've got really solid seasonality. So Google is one to keep in mind. General Motors, GM. If I drag this back 12 years, look at the climb starting in June, which is June, July, and August are all bad months. But look at this. Looks like a mountain climb. By the time you get into September, things start picking up. October, 8.8% average. Goes up 7 out of 10 years. 7 out of 10 Octobers go higher. And then November, 8 out of 10 go higher with another 3.6% average return. So when you look across these returns by month, October and November really stand out for GM. 12.4% is your average return over the last 12 years, just during these 2 months. So if things start to look good technically, just keep in mind seasonality would be a confirming indicator. Lam Research. And right now, semiconductors are absolutely getting torched. But when we go back 20 years, look at, I think October kind of just really stands out here. 8.6% return and we go up about 8 out of 10 years. So Lamb Research, look for maybe a rebound here after the short-term selling's over. The last individual stock that I'll feature, actually, I might have a couple more for you later when we look at a couple of industry groups. But just looking at individual stocks here for the moment, ALK, and I'm going to show you the chart on this one in just a minute, but average return 6.9% in October, 8.4% in November, 2.6% in December. Look at the high, look at those high percentages by month. The three highest are in the last 3 months. And also by far, this is the 3 best months to own ALK. So what's ALK look like technically? Well, it was downtrending, but as we get ready to wrap up September, it looks like we're starting to break back to the upside. So we know October through December is a good time of the year for Alaska Air Group. And we're starting to look better technically. All of a sudden, PPO back above the center line. So what I'd like to see maybe is a pullback, hit that 20-day, hold it, and then break out to new highs. I think that would help to confirm that seasonal pattern. All right, let's look at sector that I wanted to show you, and that's the XLF. Now, if I pull this up relative to the S&P 500, so what this is telling us is over the last 5 years, September, 4 out of 5 years, the XLF has outperformed the S&P 500, and the average outperformance is 1.4%. October and November, the last 5 years, financials have outperformed the S&P every year to the tune of an average outperformance, 1.3 and 2.3. So that looks pretty good. Now, that's just over the last 5 years. But if we go back during the last 9, which represents the entire secular bull market, you can kind of see that we just keep building strength. September, then we really start to pick up in October and into November as well. So this is dated back all the way through the current secular bull market. So I wanted to point it out. Now, within the financials, there are a lot of areas that like this period coming up. But one I'll show you, and I'm going to show it just on an absolute basis. So if we go back, I want you to see the last 12 years. Or actually, we could probably go, if we go all the way back, you can see over the last 20 years that October goes up more than any other month for investment services. The average return, 2.8%, also the best. What's the second best? November. What's the third best? December. Looking across these bottom average returns. So October, November, December, very strong period for investment services. Now, one of the stocks within investment services is Goldman Sachs. I thought I'd bring this up because this one, if I pull it back 12 years, look at October. It's gone up 11 of the last 12 years. Goldman Sachs. This is just on an absolute basis. Goldman Sachs, end of October, has been higher than the beginning of October, 11 of the last 12 years. And the average return, 5.3%, best of the year. So financials do well. Investment services do well within financials. And then you've got Goldman Sachs that does very well. So just, again, keep in mind the seasonality here. The last one I'll show you is the banks. Again, last 5 years, you can kind of see what's going on. But as I drag this back, 7, 8, 9. So this is since the secular bull market began. All but 1 year, October's moved higher. And every year, November has seen banks move higher. So as you go into October and November, we've already been talking about the rising yields. That plays into the favor of financials. And we know historically, banks have done very well. Financials have done very well in October and November. So we're getting both technical behavior, fundamental behavior, or all three actually. Technical behavior, fundamental, and then also seasonal. All line up bullish right now. And stock within the banks, and this is, I think, one of the leaders, PNC. And if you go back the last 9 years here, you can see PNC follows that same pattern. 8 out of 9 October's higher, 9 out of 9 November's that have been higher. The average return on PNC just over the next 2 months, average during the secular bull market, is 10.2%. That's what it's been averaging just during 2 months. So I wanted to point out those seasonality tendencies for you. So let's talk a little bit about earnings, move into the earnings spotlight. Don't really have a whole lot for you here. Earnings are slowing down. But MLHR came out. They beat on the top line, missed on the bottom line. Stock was up 2% after hours. So still going to be in this downtrend. Not really seeing that changing at this point. And when you look at the relative strength versus the furnishings index, we're down near a 52-week relative low, Miller versus its peers. So I personally would find something else. If I wanted this space, I'd be looking elsewhere. A couple of companies reporting in the morning. Probably by the time you get this recording at 9 a.m., these companies will have already reported. Paychex, you can see, has been going down. It was actually a decent stock relative to software, but it did kind of fall apart here over the past month and a half. It's going to need to get back above its 20-day moving average. I do like the AD line. I think the AD line's held up pretty well. So we'll see if it can continue. And then CarMax, another one reporting tomorrow. This one just broke out recently. AD line looks good. Relative strength, we're not too far from a 52-week high. Specialty retail, by the way, has been incredibly strong of late. You can see relative to the S&P, that's turning higher. So this isn't a stock that is in a hot area, and the stock itself has been pretty hot. I would look for a good report out of CarMax. Two others that'll be reporting, I'm not going to pull their charts up, but we have McCormick and Bed Bath & Beyond. Both will be reporting in the morning as well. All right, the three you must see to wrap up. I'm going to start with Generac Holdings, GNRC. This has been a really good stock, and that last move from May to July, look at the move, not only in terms of price, but look at the AD line moving up. Well, the stock's pulled back here over the last week, and it's providing a pretty good opportunity. Although I would just say this, I think the breakout that we saw right here is a key support, and then recent lows. So I think that's your support area right in here, 365 to maybe about 380. So watch for that. Next up is Jabil Inc., JBL. Good earnings report, heavy volume, but we came down, we lost support. I don't like that AD line breaking down, but I would probably be looking to see if this trend line right here holds, because we're right on the trend line right now from the last two lows. So if that fails to hold, then I would be careful. Last stock I have for you is Uber. Uber actually, I think, looks pretty interesting. After downtrending for a while, we saw the gap up, the big volume. We're now pulling back on lighter volume. Watch $42.50 to $43. That's where I think we might see a reversal. All right, that's it for me. I appreciate you tuning in. Next show will be on Monday over at earningsbeats.com. So all you have to do to join the show over there on Mondays and Wednesdays is just come over here and click on Trading Places Live, and then there will be a link that'll take you right into the room. Just click on that at about 8:45 on Monday. Everybody have a great rest of your week. Be careful out there. Enjoy your weekend. I'll see you next week. Happy trading.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.